Hi, good evening, everyone. I am Ramakrishnanan. On behalf of ASK Investment Managers, I would like to welcome you all for the quarterly knowledge series on our products and services. Today, we have Mr. Bhavesh Kanani to address you on the ASK Financial Opportunities portfolio. To talk about Mr. Bhavesh Kanani, he has overall experience of 17 years in equity research spanning across global and domestic markets. His domain expertise is BFSI, and prior to joining ASK, he has worked with Centrum Broking, Sher Khan, Bank of America, and Citigroup. Mr. Kanani is an MBA from IBS Mumbai. He is associated with ASK since 2013. To take a minute further, dear participants, now Mr. Bhavesh Kanani would cover the trends in the financial services sector and also update you on the portfolio, followed by the questionnaires and question answers. I would request you all to type in your questions and queries related to the portfolio. Dear Bhavesh, thanks for taking the update on the financial opportunities portfolio. We will request you to take on the session from now.
Sure. Thank you for that wonderful introduction. Let's straight away dive into the most recent trends. We just had the first quarter earnings season getting over a couple of weeks back, and I have a lot of interesting data to share. So let's first talk about the growth aspect. Just a second. Yeah. I hope you are able to see a chart on the screen now.
Yes, we are able to see that.
Yeah. So let's first talk about growth. The chart on your left top, which is depicting two lines, that is essentially the loan growth we have seen for PSU banks as a pack and private sector banks as a pack in last many quarters. And as you can see, for the entire sector, the loan growth had recovered from COVID lows in second quarter of 21 and had touched a high in Q2 FY23. And since then, there has been marginal moderation in loan growth. While private sector banks, moderation is much lesser than that of PSU banks. So you can whatever has been the traditional trend, that private banks tend to grow higher than PSU banks. That trend is still visible in Q1 FY24 as well. At industry level, large part of this growth is driven by the services sector, which had grown at 27% year on year for the quarter, followed by retail, which grew by 21%, and agriculture at 20%. Now, the manufacturing sector, which essentially has a lot to do with your large projects and such, the growth has recovered in last many quarters, but it is still pretty weak at 8%. This is primarily because of the fact that while there is a lot of capex spending happening, a lot of that spending is getting funded by private equity investments, internal accruals, and the lending opportunity is just not happening for manufacturing capex that is happening because the funding requirement is met by other sources other than the banking system. If we look at NBFCs, then clearly we need to look at the pack in terms of different segments of business. So let's first talk about vehicle finance. In total, the leading vehicle finance companies saw a growth of 25% in their loans, within which naturally Chola was leading the pack with 40%, followed by Sundaram at around 22%. Bajaj has reported a very handsome growth of around 32% in its loans, whereas in affordable housing finance companies, the growth is pretty strong, but HFCs as a whole, which includes affordable housing finance companies as well as urban housing finance companies like SGFC Limited, the total growth is lower at 8.5, 8.6%. This essentially implies that the affordable housing finance companies are able to grow bounce back quite strongly with around 37% growth in portfolio. Uh, and gold loan is basically chugging along at around 14-15% growth. On margins, which is another important aspect, last entire year, that is Q1, Q2, Q3, and Q4, we saw margins for both PSU banks as well as private banks going up. On expected lines in Q1, we saw margins coming down versus the previous quarter. So for PSU banks, we saw margins coming down from 3.2 to 3.14, whereas the contraction for private sector banks as a pack was a marginal of 4 basis points, that is from 4.56 to 4.52. This is no surprise because NIM was expected to decline. We have already seen that RBI has paused on repo rate hikes, and as a result, lending rate hikes by lenders also has halted. Meanwhile, the cost of fund continues to inch up as old borrowings which were contracted at lower rates are repricing at higher rates, whether it is in form of replacing old borrowings or replacing of term deposits by banks. That said, when we look at year-on-year comparison, the margins for banks are still higher on year-on-year basis, whereas in case of NBFCs, we have seen contraction across all of them, except for, let's say, Home First and Bajaj Finance, where the margin contraction was very small. Rest for most of them, since large part of the book is fixed rate in nature, all of them have seen NIM contraction on sequential basis, that is in comparison to Q4 of 23. And the third most important aspect is asset quality, where we have seen a little bit of mixed trends. For banks, GNPA is stable for the private sector pack, whereas for PSU banks, there was some marginal improvement. That said, as a group, private sector banks, GNPA, leading ones, average at around 2.2, whereas PSU banks, GNPAs are double that, even after this improvement. On the NBFC's front, we saw a marginal uptick in NPA for affordable housing finance companies. This generally tends to be the case in Q1, where cash flows are a little disturbed, business activity is a little dull because of monsoons, and hopefully the housing finance, affordable housing finance uptick in NPA is likely to be seasonal only. We have seen this trend in last many years, and this year it's no different. In case of vehicle finance players, the asset quality continues to improve, led by continued upward trend in the business activity, which ensures that the vehicle operators continue to receive healthy cash flows. Since Bajaj Finance doesn't fall in any of these categories, we have displayed it separately, and you can see the NPA position is stable versus previous quarter. Unique trend for this quarter was the treasury gains. This is more to do with banks and less so with NBFCs. We can see that in Q1 last year, because of sharp increase in yields, PSU banks had reported significant treasury losses. Top four PSU banks collectively had reported loss of more than 7,000 crores, whereas top four private sector banks had a loss of around 1,800 crores. Since then, yields have moderated, and in Q1 of 24, we saw PSU banks reporting a treasury gain of 5,700 crores, and around 1,400 crore treasury gain was reported by top four private sector banks in aggregate. If I look at Q1 24 results, for PSU banks, treasury gain formed a huge chunk of the total profit before tax. Whereas for private sector banks, it contributed, but the extent of contribution was limited to mid-single digit. Whereas for PSU banks, it is sharply higher. In most cases, it is around 18-20%. So this is just to highlight that treasury contribution to PBT is, while it is good that there is income, we should remember that it does not form part of the core business activities, that is lending. And to that extent, when this treasury gains normalize or we exclude those treasury gains from PBT, that is when we get the real picture. Overall, in terms of growth for our portfolio, we saw sales growing by 33%, operating profit grew by 38%, and PAT growth was further higher at 47%, largely because provisions have come down, as we just discussed, that asset quality for private sector banks and NBFCs have improved or remained stable, which allowed lenders in our portfolio to bring down the provisions further and thus push the bottom line growth higher to 47%. In comparison, BFSI sector within BSE 500 reported a growth of 17% for sales and around 40% growth in operating profits, and bottom line growth was even higher at 67%. This again has direct connection to what we just discussed on the provisions as well as treasury gains, which has been driving a lot of this growth in the financial performance. These are the most recent updated return metrics for the FOP fund. We continue to have sizable position in banks, which forms about 54% of the fund, and NBFCs contribute about 23% of the allocation, whereas insurance collectively contributes 22%. Just to run you through some key trends we are monitoring and their implications for the holdings we have currently. Domestic growth, as I mentioned in the opening of the discussion, the domestic growth has been supported by a lot of increase in capex spend. But when it comes to banking sector receiving the opportunity of lending, that has still not happened. And we expect that to happen over time as private capex trend picks up further. Monsoon has been erratic, and that has its own implications for sowing patterns and fruit and vegetable output. Naturally, two clear implications: one is food inflation, and the other is already visible in form of tepid demand for consumer staples. The implication of these trends has more to do with microfinance players as they operate in the rural areas, vehicle financiers to the extent that they are lending to the smaller, luggage carrier vehicles, and affordable housing finance companies who operate in rural areas. Food inflation, as expected, has inched up in line with the trend we have seen in monsoon sowing and all, and has resulted in upward pressure on the CPI. This is direct implication for the policy rates. There were expectations that by year end we should start to see repo rate cuts being announced. That view may undergo change if food inflation continues to persist, which will essentially limit the options available for RBI to act on policy rates. Lastly, we have festive season approaching in a couple of months, and so expectation is that economic activity will further gain traction, and that will provide opportunity for the companies we hold in the portfolio. That's all from my end. We can now open the floor for questions.
Thank you, Bhavesh, for your detailed explanation on the sector and also about the portfolio. We have curated some of the questions. We have collated some of the questions. I would like to run through some of the questions for you.
Sure.
Firstly, is the portfolio has performed really well in this financial year and has delivered a return base of around 17% since this financial start. We just want to know what is the way forward for the portfolio from now.
Yeah, so in terms of outlook, last entire year was pretty amazing because we had strong revival in growth and NPAs were coming down. As a result of these two key trends, along with the fact that all the lenders were hiking rates that improved their margins. So effectively, the operating scenario last year was favorable on all grounds. And as a result, we have seen amazing growth on bottom line. Incrementally, the NIMS has already peaked out, so we should expect NIMS to marginally go down further during the year, but it will still remain, in line with what we have seen last year or marginally better. And provisions have essentially bottomed out. Significant improvement in asset quality from here on is unlikely. So, our expectation is that since we have selected very, high quality lenders, we expect the asset quality indicators to remain stable during this year. Putting all these things or views or expected trends into numbers, we should be looking at around 18 to 20% kind of loan growth for the lenders we own. And given that there will be some margin contraction and asset quality remaining stable, that will mean that provisions may not come down dramatically from where we are today. We should expect around 18% kind of bottom line growth for full year at portfolio level. That essentially means, and in that context, where valuations stand today, valuations for lenders are not demanding. In some cases, there are value pockets which we have included in our portfolio. But by and large, the return one should be expecting over next 2-3 years should be in line with the earnings growth this portfolio can deliver, which is around 17 to 18%.
Thanks for the answer. One more question we have received is that, IDFC First Bank, for not being part of the portfolio. Is there any chance, because the stock has performed really well, it has almost doubled, we can say, in the last 1 year. So what is the view that, we can have about the stock in the portfolio, IDFC First Bank?
Sure. So let me first state that we have no rigid stance on any of the bank, whether it is PSU or private mid-tier like IDFC. All we are looking for in banks is a great track record when it comes to lending, because underwriting quality gets reflected in tough times. And we have seen the difference between how well managed lenders have been able to navigate through COVID versus not so well managed lenders. And there is a clear differentiation. So we are not getting into companies in the portfolio to play tactical play of a year. We are looking at these investments from medium term perspective, and hence it is important to select lenders who score well on all aspects and in all times, who have a proven track record of navigating through tough times. Wherever we get that comfort, we would like to include that in the portfolio. That essentially leads to the choices we have made so far, and that applies to IDFC First Bank as well. Although we keep monitoring all these names, and at appropriate time when it makes sense, we will be happy to look at it. I hope that answers your question, or you want me to delve further.
No, that answers my question. So we have entered into SBI into the portfolio.
Yeah.
So would we be seeing more of these PSU banks to be part of the portfolio going forward?
So, one reason why for many years we did not have PSU banks in the portfolio was the fact that the asset quality performance there has typically been far more worse, and even now it remains as a fact, PSU banks are worse off versus private sector banks. Even if we compare on return on assets, SBI today generates about 1.1% return on assets, whereas leading private sector banks are generating anywhere from 1.8 to 2.2%. So PSU banks return on asset is half of what private sector banks return on asset is. So that clearly tells you how big is the efficiency gap. That said, and the reason for this gap primarily is, I mean, working style, underwriting, all those factors are playing a strong role. One of the reason also is the fact that these banks do not have significant exposure to retail lending segments. Most of them are engaged in only mortgage loans. They don't do much of vehicle loans or personal loans or credit card and all that stuff, where yields are far higher compared to corporate loans or SME loans. We see some of the banks trying their best to improve the mix of retail in total loan book, which is what we have seen in case of SBI, and hence we decided to enter the name because these are structural changes. Today, State Bank, within matter of a few quarters, State Bank has been able to generate a book of 3 lakh crores in personal loans, solely driven by deepening in the existing customer base itself. So wherever within PSU banks we see important and structural changes happening, which can take the return ratio profile itself to next orbit, we would be willing to include such names in the portfolio. So we will continue to use the same filters that we've been using in past, and accordingly, whatever comes through those filters, we'll be happy to look at it, whether it is PSU or otherwise.
My next question is on the sectoral. When in the complete BFSI, when we look at our FOP portfolio, we are more or less into three divisions like banks, NBFCs, and life insurance. So
Yeah.
any chance that we are looking towards inclusion of AMCs, asset management companies into the portfolio going forward?
Yeah, we had HDFC AMC at one point of time, but as you would have seen last 2 years, the AUM growth has been pretty weak. Along those trends, we have also seen their margins coming down dramatically because of a lot of AUM churn. And as a result, the bottom line growth has just not happened for even HDFC AMC. In this quarter, we have seen because of uptick in equity markets and higher mix of equity in the total AUM, there was revenue growth of about 10%. But bottom line growth looks very impressive only because just like bank treasury income, even AMCs had a lot of other income. But when we strip off the this one-off gains in other income, the core income has grown by only 10-11%. So it's a space that is interesting. We always wanted to have at least some allocation to saving story, and we are open to. I mean, we also monitor other quasi plays for savings, such as wealth managers as well. So when it makes sense, we'll certainly enter, and that is a space we really like, given the long trajectory of growth available for the entire sector.
So we are listening a lot of buzz on the Geo Financial Services. There's a day-to-day news happening on that one. So we just need, we have received the questions on what could be our view, when could it be part of a portfolio, when it can be a competitor to Bajaj Finance in the going forward. So this is one of the questions we received.
Very interesting question, and I'm sure most players in Dalal Street are looking for answers on this matter. As the matters stand today, Geo Financial Services essentially today on its balance sheet holds some amount of net worth and treasury stocks of Reliance Industries. As of now, we do not have any details as to what they intend to do with the balance sheet in terms of what new businesses they would want to enter. They want to build it organically, or they'll be buying out companies to straight away foray into segments. There are a lot of media reports talking about them wanting to foray into insurance space by acquiring some company. So today, to judge the company on purely financial performance, there is no business as of today. So to ascribe any value where the plants are not frozen or there is no business on ground as yet it limits our ability to ascertain value of such names. So whenever they happen to begin the business and reach a meaningful scale, we have fair idea of what they are trying to do, how they are trying to do. Maybe we'll take a detailed look at the name. At this stage, since there is no business, we don't really have a view on what is the right price.
Thank you. And one more question is, so with respect to the merger of HDFC Pins into HDFC Bank, the weightage of this particular, stock has increased into our portfolio. So would we continue with the same weightage, or what is our view and what we'll be doing with this merging of this?
Yeah, so agreed that combined weight looks pretty high, but when we look at sectoral indices like BSE Finance, the combined weight of HDFC Twins in the BSE Finance Index is 29%. So our current weight is significantly below that. So going to a 30% weight has its own, risk-related implications. But in terms of business itself, how the merger is likely to pan out, we believe that the merger essentially is going to lead to some contraction in return on equities in the near term for HDFC Bank, because the leverage of HDFC Limited, financial leverage was lower than that of bank. So combined entity will have same return on assets, but the ROE will take little bit of a dip. Over next 2-3 years, however, we should expect ROEs of HDFC Bank combined entity to go back to its pre-merger levels. Why this should happen is, one, HDFC Bank has to first replace the borrowings of HDFC Limited with term deposits or other deposits. With this in view, HDFC Bank was already aggressively opening branches last entire year, and they continue to maintain that pace. They would have added something like 1,400, 1,500 branches last year. And most of these are into new locations, cities where towns where HDFC Bank did not have a presence earlier. So essentially, all these efforts are with a view to replace high cost borrowings of HDFC Limited with lower cost resources of HDFC Bank. Second important area is on balance sheet growth. SGFC Limited used to have around 600 branches from which it used to offer mortgage products. In comparison, SGFC Bank has 6,000 branches, more than 6,000 branches. So before merger, SGFC Bank's ability to offer mortgage products to its own customers was limited by SGFC Limited's small branch network. After merger, SGFC Bank can roll out mortgage products to its entire branch network. And they have been working on this in terms of training the staff, getting the systems ready. And over time, in next 2-3 years, we should see rollout of mortgage products in practically entire network of HDFC Bank. This will support higher growth opportunities for HDFC Bank. And driven by these two factors, we believe that over time we'll see ROEs coming back to around 17% for the combined entity.
Thank you. We have a couple of questions. One question is, the ICICI sector is a brokerage businesses. One more, businesses. I need an outlook on ICICI. I mean, the businesses like brokerages, because more of the discounted broking companies are coming, like Zerodha and all. So we just want one outlook on this one.
Well, on broking names, one essential element one should look for in any sector is the pricing power, which is essential to any company's healthy financial performance, whether it is manufacturing or financial services. Broking is one sector where it is a highly fragmented sector and no individual player enjoys any pricing power really. So that is one. Two, large part of the income for a lot of these broking names and even NSE as an exchange is coming from options related transaction charges or brokerage charges. So large part of revenue is coming from an activity which is in a way speculative in nature, although there is no official data as to of the total volume, how much is speculation and how much is actual hedging. But when we look at the higher share of options revenue in total revenues, and also remember the fact that SEBI had published this data that out of all the people trading in options in India, a very small percentage of people are able to even generate 7% return. It's a very small fraction of total people trading in options. That makes us wonder as to the sustainability of options volumes on sustained basis. We would rather, play the capital market or saving story through AMCs and wealth managers instead of brokers. That's our current stance.
The final question for the day we have is for an investor who invested around 5 years back, we have generated double-digit return for the client. So it was slightly, below the benchmark. What could be the way forward for such investor? Is what one more last question we have.
Yeah. So when we look at, let's say, Bank Nifty or BSE Financial Services Index over very long periods, you will find that in normal times, the banking sector has outperformed Nifty by a wide margin. But when it comes to difficult times or times of crisis, this sector tends to underperform largely because this sector is primarily consisting of lenders, both the indices. And lenders, by virtue of their business models, are high leverage business models. In case of banks, the leverage can go up to 9-10 times. In PSU banks, it is even higher at 15-16 times. And as a result, when there is any crisis in the economy, the financial services sector gets more hammered than, let's say, manufacturing sector or other sectors. In last 4-5 years, if we look at the impact of COVID itself, it has taken away easily 1.5 year worth of time away from normal business activity, because practically all the lenders were busy handling their existing balance sheet and the implications COVID left them with, rather than focusing on growth. Uh, it is, to me, it is a great achievement, the manner in which the entire financial services sector has navigated through COVID crisis and has come out stronger. Even today, well-managed banks and NBFCs continue to have extra provisions over and above what is required by RBI. That tells you volumes about how soundly managed these entities are. Because one, they have handled the NPA that came because of COVID, and they still have spare provisions, extra provisions on balance sheet. So essentially, we have lost. I mean, it may look like a 5 year period, but in reality, for companies, uh, 2 years, 1.5, 2 years were essentially lost because of COVID crisis. In a normal operating scenario, which is the hope, one can't forecast such black swan events, but in a normal scenario, looking at the kind of growth that is envisaged by Prime Minister Modi, the kind of targets they are running with, those kind of numbers, if they were to happen over next 5 years, 10 years, that cannot happen without support of banking sector, because every activity requires funding. So growth opportunities for these sectors are only going to get brighter. It's just that we need a normal operating environment for these entities to perform to their maximum capability in terms of growth of balance sheet as well as generating returns for the investor. So, in hope that there is no adverse event around the corner, I would expect this sector to be, continue to be a major contributor to overall returns of the market. And what also helps is the fact that valuations are not too demanding for this sector. You look at any name, the valuations today are in line with the kind of return on equity they are delivering. And in some cases, the valuations are below where they should be. So the return potential from valuation is also supported. So this sector, in my view, given the normal circumstances or normal operating environment, can do wonders for the portfolio.
So one question is on the Cholamandalam, since they are majorly into the two-wheeler segment. One question we have received on Cholamandalam.
They are not major in two-wheelers. In fact, Cholamandalam is the most diversified vehicle finance player. So they have some exposure to big vehicles like trucks and whatnot, large trucks. They also have exposure to LCVs, utility vehicles, car, used vehicles, tractors, construction equipment. Two-wheeler is not one of them.
So we have received all the questions here. We'll wait for 1 more minute, take any more questions, then we can wind up.
Sure.
So dear participants, if you have furthermore any questions, we would like to request you to key in your questions now. All right, sir. I think we are out of questions now. Thank you, Bhavesh, sir, for your elaborate answers for the questions and also your update on the FOP and also on the BFS sector. Thank you so much for being part of this call. Thank you, everyone who has attended the call.
Wonderful. Thank you. Thank you, everyone, and good day.